Well, good evening and welcome to this live stream on the 1st of July 2025. I'm Martin North from Digital Finance Look here. Great to have you on tonight. And thank you very much for spending some of your Tuesday evening with me. It is very warm weather over here, but a little less warm down there, I think, at the moment. So we might touch on that on the way through. But important conversation this evening. End of the financial year, of course, start of a new financial year, markets all-time highs. And what does it mean? And that's what we're going to try and explore tonight. Before we get into the detail, just remind you we don't provide specific financial or legal advice. This is a general conversation only. We moderate the chat, but feel free to throw your questions, comments, suggestions in as we go. And if you'd like to get a question directly to Damien or myself, if you use @WalkTheWorld, that'll make sure that I see it in my queue. I've also enabled Super Chat, which means you can get your question to the top of the list, or indeed make a contribution to what we do. And here we really appreciate those who do help us by supporting us financially, either via the Super Chat or via Patreon or via other means, including PayPal. That really helps us to do this. We don't do this for profit. We do this because we think there's a really important conversation to be had, and you certainly help us to keep our head above water. Anyway, I suppose talking about keeping our head above water into the financial year, new financial year, what does it mean? And we're going to bring Damien in. We're going to start exploring that now. Damien, welcome back. How are you doing?
Yeah, very well. Very well. It's good to see you again. It's been another busy month, as every month seems to be so far this year.
Well, it's certainly a case that there's never a problem about finding things to talk about, right? So the problem is more we've got so much to talk about. How do we focus in on the most relevant and important things? And I guess
and that sounds like the Trump's presidency, as a whole, isn't it? There's so much noise going on. Trying to focus in on what do I need to care about as an investor, and what's just noise.
Yeah, and Damien, it's worth, I think, highlighting that you've got a global view and the local view with the world funds and nucleus wealth. We've got a number of investors who are invested with you, and so very interested in terms of seeing some of the things that are actually going on at the moment and trying to make sense of it. And I guess what we're trying to do here is tune out the noise and try and look at the signal. And there's one I want to start with because I just think it's a really relevant point. Of course, if you look at the S&P 500 all-time high, 6,200. If you look at it another way, which is looking at it in terms of the price earnings ratios, this is the US, you can see that the S&P 500 is at 22 times forward PE, which is way above the typical range. The Russell is even higher. The NASDAQ is even higher too. Interestingly, the equal weight is a little less extended, but still high. And the mid cap is sort of sitting in the middle of the band. So on one level, you could argue possibly that we've got significant overvaluations there, right? And I know a lot of people would probably buy that argument, but I do think there's a counter argument that's worth thinking about. And that is, well, actually, what happens if those historic ratios are a bit out of date? And I'll just show you this slide, which I think is really interesting. This is the global money supply, the M2 globally, tracked to the S&P 500. It's lagged a bit by 11 weeks. And what it shows you is that the money supply is massively accelerating. And, possibly that means that actually there is still more upside potentially ahead. So it's not all about, downside from here. There is also an upside scenario to consider too.
Yeah, yep. I've got about 20 things I wanted to let me just write a few things down while you, because during you saying that a whole bunch of things popped up that I thought I'd talk about. So we spoke a lot. What we spoke last time a lot about was saying, look, there's a lot of dangerous things that Trump is doing, and it feels like we're skating close to the edge of the cliff, and maybe he gets things wrong, and maybe we go tumbling over the cliff and you into recessions and all that type of stuff like that. But the issue also comes about, okay, what if it doesn't? And also we spoke about him sort of cherry picking other people's philosophies. So, he brings in Elon Musk, kind of cut costs and save all these things. And it's like, well, I'll do a few of those things that I like, and then I'll throw away the ones I don't. And then it's, I'm going with the Besant plan, but, except for those deficits of things, I don't like the idea of having to stop spending money. So we'll do all these other things, but we won't do that deficits part. And I'll pick and choose what I like of the tariffs. And so you sort of quite possibly you end up with a grab bag of like six or seven different competing economic theories, and all he's done is grab the ones that sort of boost the market or seem like they don't have much pain attached to them. And so yeah, and so then maybe you end up in this scenario where where you're pouring trillions and trillions of dollars from into back into the American economy. And companies are usually pretty good at picking up that money when it comes. So if you've got to, if you sort of think about it largely as there being three sectors, a government sector, a household sector, and a corporate sector, is that corporates tend to be pretty good when governments are spending too much money or spending way more than they're earning. Corporates seem to be pretty good at increasing their profits in those time frames. So yes, that's one part. um,
And
the
just
next part.
sorry, just
Oh,
on
sorry.
that,
Mm,
the Trump interjections are really interesting, right? One of them is Powell. He continues to say that Powell has kept interest rates way too high, and that they should be cut by a couple of percentage points. And of course, he's now talking about finding the next replacement ahead of when Powell is due to leave, and is actually almost saying, "Hey, Powell, you should go." Now, markets
yeah.
are beginning to wonder, could this actually come true? A few months ago, they would perhaps have thought it wouldn't. But now, again, if you have rate cuts on top of everything else and all these other chaos of policy,
Throw more
throw more,
fuel on the fire.
fuel on the
Yeah.
fire. Exactly right. And so
So
again,
it burns
markets.
really hot, burns really high, and then does it keep burning or does it flame out? So yeah, that's and we spoke last time, you got rid of all these consumer finance protection bureaus and all this stuff like this. Like you can see where there's maybe this is just gonna be the boom of all booms. It's just like, let's just throw as much fuel on the fire and see how hot we can make this thing before it all comes crashing down.
Right.
And there's been plenty of dictators who have decided that they've got a new way of doing things, and Erdogan from Turkey's probably comes forward to the fore in terms of that. His idea, and so he ran a whole bunch of his. I think what was his take was that low interest rates are actually bring down inflation. High interest rates increase inflation, and low interest rates bring inflation down. So he ran that test for a number of years before working out, well, even though the market disagreed with him from the start, he had to see it for himself. So, maybe Trump's sort of in the same path about going, well, maybe and the other thing is, the US economy is very adaptable, and it's a very strong economy, and innovative, and all these other things that go with it. Is that it can probably take more than your average third world country or your average sort of developing country, like a Turkey or something like that, in terms of how it can handle these. And there are sort of offsets you might find from other countries that are with its currencies moving in particular directions and all that, because it does drive the world. Maybe it can handle more bad economic policy by sort of offsetting the effects of that policy on other countries than what you might find in a country like Turkey. Yeah.
Well, especially, of course, because the fact is that there's still a huge dollar imbalance. The dollar is still the currency of choice, even if it's worth just reflecting on the DXY, which is down 10% or thereabouts from its peaks. But it is worth, I think, just standing back and looking at the DXY over a longer period. And if you do that, what you can see is that the 96, which is currently where it is sort of in the middle of the range. It was down a bit, it was up a bit. So let's not get too sanguine about the dollar moving. But I always think you have to, when you think about what's going on with the markets, exchange rates are another critical factor, particularly, of course, if you're investing in offshore markets. And sometimes it's the exchange rates that actually are the more influential ones to watch. The other point, just on that, of course, we've got the big bill sitting at the moment in the Senate in the US, and they're debating it, which could potentially lift borrowing even more and shift money around quite dramatically from one section of the economy to another section of the economy. But that could potentially be, on one hand, inflationary, but it could also be, on the other hand, stimulatory. So there are so many of these variables here. And, I keep coming back to the uncertainty level is very high, but that means that there is an upside scenario that you have to consider as well as a downside scenario from here.
Absolutely. And I'm going to go through a bit of that today. And sorry, the other thing as well on that part as well is, the inflation we saw post-pandemic a big chunk of that uh, was about supply chains and that whole demand. All of a sudden a big demand for goods and versus services. So my sort of overall take is, look, we've been in this deflationary environment for a while. China's, busily trying to cut costs in terms and sort of bring down the price of products. There's deflation sort of rampant in China. It would love to export to the rest of the world. So you sort of got this sort of naturally deflationary environment sort of meeting a lot of these inflationary policies. And so, the question about how inflationary all these policies are going to be is a little bit uncertain. And then there's also that, I mean, we're sort of very eagerly waiting sort of at the end of our 90 days to find out what all the rates are on different countries, because China keeps automating, cutting costs, pushing through those things, but they're spreading out now to there's lots of, if you're a multinational, from what I've sort of been looking at for a lot of the big companies, is they sort of go, yeah, look, we produce whatever 60% of everything we produce in China, but the other 40% comes from, there's Vietnam and there's Eastern Europe and there's, all around the rest of the place. And so when they're talking about US tariffs, what they're talking about doing is saying, well, we don't really want to produce widgets in Eastern Europe and ship them all the way across to the US and then bring in our products from China and ship it into Western Europe. But if that gets around these massive tariffs, then we'll probably do it. And so what they're sort of looking at is going, well, if these tariffs hit and prices all go up by 5%, maybe our costs only go up by 2 or 3%. We'll actually expand our margins, and it's actually all the small companies who'll suffer because they can't, they can't get the stuff out. They can only get from China or whatever it is. They've only got one supplier, and so they're all sort of busily trying to do it. So that's one part. The other part is supply chains might be an issue, but I doubt it this time around. It's rare. It's rare that the last, whatever caused the last problem caused it again. So when you spoke to CEOs back during the pandemic about what's happening in the supply chain, they really didn't have a clue. Like, it's sort of like, this is something I haven't had to worry about for 20 years. I've never looked at it. Stuff just turns up. People somewhere in my organization sort it all out, and all of a sudden CEOs are like, this is the most important thing ever, and they've got to manage that risk and everything like that. And so they learned. What does it take? What's happening with the supply chain? Where does it go? Where's it come from? And so this time around, it was only 3 or 4 years ago. We're bringing out the playbook, right? We know what happens with our supply chains. Our supply chains are way better than they used to be because we've been spent the last 4 or 5 years trying to diversify them and get fallbacks and all that type of stuff. And now we have a situation where we're going to use it. And so so I do think there's a certain positive in that. That was, yeah, so that was those. Then that currencies. I've got a chart up that I thought it's worth showing on that currencies, which is Bloomberg chart from a couple of days ago, and that's basically looking at the S&P 500, but doing it in different currencies. So the blue line is in US dollars, and so you can see, yes, it's back to its highs, but the black line's in yen, and so it's still down sort of 7 or 8% from its highs in terms of yen. If you look within pounds or euros, it's down closer to 10%. And similar with gold as well. If you're going to measure the thing in gold, that's the I don't know what you call it, an orangish line, orangish reddish line. That is sort of showing that depending upon what you're measuring it in, the US dollar has done a fair bit of that fall for you. And so, so it is, while it's back to its highs in terms of its own currency, it's not back to its highs in terms of other currencies.
And that's very important, isn't it, to understand that the currency impact, therefore, is differential. So if you were looking at Japan versus the UK versus the US versus Australia, you get some quite different outcomes. I mean, it's worth saying, of course, that the Australian market over the last year is up, 10%. Pretty much. And in fact, I've got a question in the poll here as to whether people think it's going to do the same or better next year or less so. It'll be interesting to see what people think, or is it impossible to tell? If you'd asked me 3 months ago, is it likely that we'd be up 10%? I'd have thought probability quite low. But hey,
3 months ago. That was at the day. That was the day before Liberation Day, wasn't
yeah,
it?
exactly
What
right.
about two,
April
two
the
months
second, April
and
the second.
28 days
Yeah,
ago? Yes.
exactly. Yeah.
Yeah.
So it shows you that, and look, if we'd stayed down, then of course the outcomes would be quite different. But if you look at it over that period, but I suppose it also depends a little bit on when you start the benchmarking data point from, right?
Absolutely, absolutely. It's always an important thing, and I think the thing I spend a fair bit of time talking to investors about is, particularly people who've been sitting on the sidelines for a long time, is about saying, look, um, we're at this point now where markets they're back to their highs, okay, and they're expensive, no doubt about it. Um, I've got people who've been sitting on the sidelines for 8 years with cash, going, I'm just waiting for the market to fall and then I'm going to get in. And you're going to miss some big rises if you forever are waiting for like the golden chance, and it's a time when everyone's like shakes you and says you have to go and invest right now.
Yeah.
So there's a part where basically I sort of try and come back to people to say, look, you've either got to take a view, particularly let's say for superannuation. You've got superannuation, you've got more money going in every year. Um, Take a view that sometimes going to win, sometimes going to lose in investment. I'm just going to set that up and go running, and we'll lean into the cycles and lean out of them, but we're not going to try and pick the whole thing. But if you're sitting on a big-ish pile of cash and you're like, when do I invest? The thing for me is saying, look, you want to have a plan to actually get that money in over a period of time. So you might think the market's about to fall apart. And if that's the case, what I'd be saying is, well, pick a time frame, call it whether it's 18 months or it's 3 years or it's 5 years, of saying, if the market doesn't fall apart in the next 18 months, is it going to fall apart? Will you admit you were wrong if it doesn't fall apart in the next 18 months? Or is it 3 years or 5 years, whatever the time frame is, and then say, look, just get started. Stick 10% in now. Wait a little bit, whatever time, 3 months, 2 months, 6 months, stick another 10% in with a view that you're just going to keep doing that over that time. If things get worse, you can always stop. If things get better, sorry, if things get worse, you can either stop, or if you think they've hit the bottom, you can then go, well, I've invested 20% and now we just had a market just fell a truckload. Now I'm going to throw the other 80% in and get back in at whatever lower levels. But there's this thing about saying, if I'm wrong about the market falling apart, I'll be wrong over the next 6 months. If there's not a recession in that time, or 12 months, then I'm just going to admit I was wrong. And so start that process so that if you are wrong, you end up by the end of the period invested anyway, and you're often, and now you can start going on a more normal basis about tilting in and tilting out. Because I think that's the biggest problem I see with people is just sitting there and just like forever going, I just have to wait for the perfect moment before I invest anything.
Yeah.
And it's
Well,
like,
the,
well,
the
it's
truth is,
definitely
you,
perfect.
you you cannot predict where that perfect moment is until it's
Mm,
past and it's too late anyway. And what I always remind people is, you know, if you look over the long term, markets go up and to the right, right? They might go
mm,
up and down, but over, if you take the medium term view. So if you're thinking about superannuation, which is for many people 20, 30 years down the track, up and to the right is predominantly the direction. And just to remind everybody from the chart I put up earlier on, global money supply continues to grow. And as global money supply continues to grow, it's chasing assets. Therefore, asset prices have a tendency to rise. So it is a fundamental uh, function of the way that modern financial systems work and the way that governments are funding everything. Now, if that were to change, so if suddenly everybody said, "Oh, we're going to do tight deficits and we're going to pay it all off," and that might be different. But there is no intent that I can see anywhere of government seriously wanting to dial
that
the
back.
debt debt bomb down. They probably can't do it in any case, and if they did, the consequences would be quite significant. And you have the MMT thing, which said, "Don't worry, because you can invest more in growth, and therefore growth is the measure rather than the debt itself."
Yep.
2 points though. Firstly, of course, you are mortgaging the future even more by doing that, right? Because
Yep.
what we're not seeing is the commensurate increase in growth that you would expect with the amount of money that's being printed, right?
Mm.
Secondly, it's also pumping all asset prices, including house prices, ever higher. And that means that effectively you've got people swept along in the updraft. But if you are actually an individual investor, uh, you need to ride the draft because it's continuing to rise, right?
Well, you can either say, yes, you know what, this is, this rise shouldn't happen. It's bad for the economy, it's bad for the world, it's bad for all these other factors. I'm not going to profit from it. I'm going to stand aside and I'm going to let everyone else profit from it. And if that's a choice, that's a choice. But if you're here to invest in stocks, you need to sort of take a view on that at some point, as to whether whether you want to be involved or not. And I think there's this, the other, I mean, we've spoken a number of times when I've been on this about this whole inequality part, and I've got a whole bunch of other things it is, but largely, if inequality is increasing, and Trump's tax cuts are very much in the favor of inequality increasing, it's another reason why stock markets go up, because when I give another $10,000 to somebody who's on $500,000 a year, they are not going out and buying stuff with it. They've already got enough money to buy what they want. They're probably just investing that back into the market somewhere. If I give another $1,000 to 10 people who are on the lowest income, they're rushing out and spending it and buying things. They're not going and so that sort of part about I'm effectively taking from poor people by giving them less services and less Medicare and stuff like that, and giving rich people tax cuts probably says higher stock markets. X the fundamentals. So the fundamentals, yeah. So I've got, and so that was where I wanted to get it. I'm almost at my launching point, Martin. I thought maybe I could talk briefly fundamentals, and then I wanted to get into what we're talking about is what are all the things that could actually drive the market higher, because there's a number of interesting quantitative strategies and sort of quant measures out there that actually sort of suggests that, look, it doesn't really look like the markets are at extreme points at the moment. And could you see scenarios where it does just drive higher? And I wanted to sort of get into that from this is not a fundamental view. This is a technical view and a market timing and what are other people out there doing, and a leverage sort of argument.
And just on that, I just want to highlight, we're talking at one end, the technical view, when you were trying to do the analysis on price earnings ratios and forwarding the multiples of future revenue from companies at one end of the spectrum, through to, let's call it momentum, right? So basically it's the herd instinct. Everybody else is doing something, so should we be following along? And if enough people do it, then the herd instinct can drive the market somewhere different. And that there is a spectrum of people playing across there, from fundamentals on one side. Trouble is that quite often fundamentals will say one thing, the herd decides something else, and the power of the herd is pretty big.
That's right. And sometimes the herd will decide, look, things are going to get worse, but then they're going to get much better after that. And so just ignore the stuff getting worse in the interim. And that's where you get some interesting divergences. And then the point that will need to come at some point, if things do keep getting worse and worse and worse, then eventually the market will sort of run up, and then it'll go, actually, I can't ignore this anymore. And that's when you get those big crashes. But other times it'll just go up or sideways and just ignore the bad news for 6 months, a year, and so if you're fundamentally going, no, things are getting worse, the markets need to fall, is every now and again it's just like, well, no, they haven't got worse. They ignore it for a bit, and then the rise starts. So, but actually, let's talk quickly the fundamentals, because that's I've got a chart up just sort of showing the S&P 500 earnings per share. And this is what I've shown a few times, where each of these little sort of red lines on the chart shows the individual years. And then the blue line is the forward earnings. So what's expected over the next 12 months. And this is sort of goes back for about 30 odd years. And you can just sort of see that it's got that gradual rise. And that's why the market go up, is because the earnings go up over time. And if we sort of look at the end of that time period, we can see that blue line is still rising, and actually it's been sort of hooking up at the moment. So we've got this sort of black line that's falling down, which is what are people expecting for 2025? And so that's been falling down, and 2026 is the forecasts are decreasing as well. And if you look at it at the next year as well, at 2027, the forecasts are decreasing, but they're not decreasing so fast that the blue line isn't rising overall. So basically what it's saying is, analysts have got a forecast for, say, 12% growth, and then they've brought that down to like 9%, but it's still 9%, which is still a pretty good return. And so it's, you can be focused on that. Look, earnings were 12%, now they're 9%, things are terrible because they've come down 3%. Or you can be focused on the fact that, well, they're still 9%. That's pretty good. And so it's trying to come back to work out where that yeah, where that is in the whole scheme of things. And so at the moment, it's the fundamentals. They don't look great, but they don't look bad either. Like they're certainly not. Sorry, the trajectory doesn't look great, but they're still at pretty reasonable levels in terms of the growth we're seeing. Okay, so that's the fundamentals. Um, they could get worse, and if they get worse, everything changes. But what I wanted to run through is a whole bunch of things that's going on in terms of more what market participants are doing, and can this turn into a much bigger thing than what it is at the moment? Can it turn into a much bigger bubble than where we are? So from a valuation perspective, you go, oh no, it's all pretty high. Where else can you go? And I guess I've got a couple of different charts. Actually, I might skip that one. Actually, this is just sort of showing bull markets for a long time, but I might show this is effectively the same one. S&P bull markets. The red line's just showing where are we now so it's been running up for 2 years or so. And we're at this red line, which is sort of down in the middle of the whole thing. 2020 got another whatever it is 10-15% higher. Most of these other runs, they went for longer or finished higher than where we are at the moment. So yeah, so if you're sort of looking at us in a bull market, we're not. It's not like a particularly long bull market relative to where it's been previously. So yeah, maybe that means it can go higher. If you look at now, I've got a whole bunch of these different types of things, but this is an overall equity positioning type measure, and it's done as a Z score, where basically what that means is that when you're at zero, that's basically everyone's got the normal amount of stocks that they have. Back in February, people had lots of stocks, so they were sort of at a not quite a standard deviation, but close to standard deviation above where they were their typical place. That sort of plummeted around Liberation Day, but it's still low. It's still below average. So what does that mean? It's all of these are sort of like a two-edged thing. One is it means people are looking at the stock market and going, yeah, I want to have less stocks than I usually have. But the flip side is, if things don't go wrong, all these people will need to buy back in at some point, and that's where this argument about um, is it the trajectory of where this thing's going, or is it the current spot? And I think with all of these, it's both. So when this is moving up, stock markets are moving up. When it's moving down, stock markets are moving down, because it's just people switching in and out of stocks. But when it's at its extremes, so you can see that it sort of hit that extreme back in May. It sort of hits that point where, look, so many people are out of stocks. There's actually only one way it's going to go, which is people have to start buying back in at some point. And so, from that perspective, can we see people buying more stocks? Would that drive the market higher? Absolutely. Then you look and you go, these commodity trading advisors, so CTAs, which are basically a momentum model, similar to so basically when things are going up, they buy; when things are going down, they sell. And this is it's the robots buying and selling, so to speak. And this is sort of showing, if you've got an SP trend following position, there's sort of three different strategies you can do: a short-term one, a medium-term one, and a long-term one. And when they're all pointing in the same direction, as we saw, last year, that's when markets are all rising. All the measures are saying to these commodity advisors, you just got to go out and buy more stuff. They all flipped negative, sort of back in sort of around Liberation Day. But since then, the short-term one has now very much saying buy. The medium-term one is also out there saying buy. And while the long-term one is saying sell, it's actually just about to flip from sell to buy. It's sort of back to that sort of almost neutral position. And sort of, so I guess if you're talking, what are the robots doing? Well, as long as we don't see any major market falls, the robots are about to all start piling back into stocks, even on the long end. Where are these guys positioned at the moment? Well, they're at the sort of 30th percentile. So they can go, they can go up to the 100th percentile. So they're sort of underweight, so to speak, where they are. And so, they're the 41st percentile at the moment. So can they buy more? Yeah, they certainly can. They're not at extreme levels. When you're looking at them and they're sort of right at the top of it, it's like, okay, they've all got excited, and they've all gone and bought this and pushed the market to a certain extreme, but they just can't buy any more. Whereas, their positioning at the moment is certainly not extreme. Um, okay, so that's your momentum traders. Then you've got sort of something similar, which is long short equities, and so long short hedge funds. And so what these guys do is you go long stocks, long one set of stocks and short another set of stocks. And so the idea usually it's something that might be you might do it as something to like you usually have some offsetting positions and you might have a particular strategy you want to get out of this. So um, what's an example is you might be saying, look, I could actually go short, say, iron ore stocks if I wanted to, but that's a pretty volatile position and that might push me out. So maybe what I'll do is actually I might go short the entire index, the ASX index, and then I'll go out and buy all the stocks except for the iron ore guys. And so now I've got this position where I've sold a dollar's worth of the index, and then I've used that to go and buy a dollar's worth of stocks. And so my net position is actually I haven't really even put any money down on that trade because I'm long and I'm short. Yeah, I need to meet the margin calls if I get it wrong, but I actually haven't got any money at play in that. And now if they move in that particular direction, I'll benefit from that. So what this is measuring is most of the time, long short funds tend to be overgeared on the long side. So it might be, a common one is 130-30, for example, which means I go out and buy 130% of stocks and then I go and I short 30% of stocks too. So if I started with $1 million, I go out and buy $1.3 million worth of stocks, and then I fund that by the $1 million I had, plus I go short $300,000 worth of other stocks. So I sell stocks I don't have to get that money. So anyway, so these guys, this chart's sort of showing that back in the 2021 they were basically two times overweight. So basically they were, if they started with $1 million, they had $2.2 million worth of stock, and they'd gone short whatever they needed to go short in order to get that back to the level. So where are those guys now? Well, they're back at 1.6. So yeah, they're still more long than short, but they're certainly, they could buy a hell of a lot more than what they've got now. And that again would drive that market higher. So it's the long short funds. Each of these is sort of, yeah, as I said, these are just all these little quant strategies that are out there sorry, when I say little, all these quant strategies out there that will have hundreds of billions of dollars behind most of them. The volatility control, this is a chart from Charlie McElligott, who sort of runs a lot of these things about saying what are these strategies, what's going to happen with these strategies and what do they need? What's going to happen next? And so volatility control is this idea that what we're doing is, sorry, let me just pull this one up. So these guys, I just need to get this. There's two different strategies. There's risk parity and volatility control. They're very similar, but what it is you're basically saying I'm going to target, say, 5% volatility in my portfolio or 10% volatility in my portfolio, and when the volatility of equities goes up, so things start rising and falling a lot, then I have to scale back what I'm doing in equities. So I'll buy more cash and bonds. And then when volatility falls, then I'll buy more equities. And so volatility has been falling quite significantly. And what that means is based on this model, as at last week, uh, these volatility control funds were actually, when they all do their sort of end of month numbers or their latest ones, they're all going to start gearing up and they're all going to say, well, I sold down all my equities because things were so volatile around Liberation Day. Now the volatility has all gone away. Now it's actually time for me to start buying back in again. And so yeah, they look like they're sort of going to be like a record buy of the amount of the amount of stock they're going to need to buy to bring up because the volatility in equities has fallen so much. A similar type of strategy is what's called risk parity. Now, I sort of think about volatility control as being relatively short term. Some of the risk parity ones, I feel like they're often a little bit more longer term. And so what risk parity is it's this idea of saying, well, I've got a stock portfolio and a bond portfolio. because the stock portfolio is more risky, and the bond portfolio isn't, I can basically take debt out against my bond portfolio and gear that up in order to bring up the risk of that bond portfolio so it's more similar to the risk in my equity portfolio. And so yeah, anyway, so that's the rough thing. And when they're out borrowing more money and increasing the risk, then they're it's effectively like they're taking out margin loans on the stock market effectively. And so what that means is from this perspective is uh, that you've got a bunch of people out there, and these tend to be quite big asset allocators who are effectively borrowing money to go out and buy more stocks and bonds. And at the moment, these guys, so the chart I've got showing up there is their model portfolio weights, what they've got in equities. And because we had all this volatility around, they sort of reduced their amount, reduced their lending and reduced the amount they've got in equities. And so they're pretty close to well, in terms of percentiles, they're at sort of the eighth percentile for where they are. So they can increase funds as well. So basically what I'm saying is, the story for each of these as we're going along is if we don't see an event to knock the markets off course, then all these guys, these are just quantitative models for the large part. The short-term traders are out there buying already. The medium-term ones have started. The longer-term ones are getting going as well. The risk parity guys, their models are going to tell them go out and buy. The volatility control people, their models are already telling them go out and buy a record amount of stocks next month. Like there's just all these, and then mostly these things are mechanical. So sometimes you can have managers step in over the top and go, no, 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 it's too risky. We're not going to do that. But most of these strategies are sort of set up as the model says go out and buy. That what we're doing next is we're going out and buying.
Yeah, and just on that, I want to highlight an article from The Economist. I don't know whether you saw it, but it was actually quite interesting. It was titled, whoops, let's go into there. There we go. Oh, there you go. Investors ignore world-changing events rightly. And this is basically saying that, all of the noise and all the other shenanigans, actually investors are just plowing on regardless, right? And it translated into a bit of a meme. Nothing ever happens. So in other words, you continue to climb higher because you just say, oh, the other stuff, I can tune out of it. And again, you just look at the other stuff. And that's the reason why markets continue to bubble high. Nothing ever happens. So all these other external events, the bombing in Iran or, the trade stuff, et cetera, et cetera, it's noise.
Hmm. Yeah, and I do think there's a lot of stuff going on that Trump is doing that is outside the range of norms. And so it might be saying, yeah, I'm gonna accept a $500 million plane from somebody as a bribe or whatever, whatever it is. That people go, this is terrible. It's gonna put a dent in society. You've got the rule of law, certainly a number of legal decisions, and you sort of like it, it's chipping away, and you're allowing this grift, you're allowing, people to go out and accept, $500 million bribes from people, and you're going out and you're running crypto schemes while you're trying to regulate crypto and all these things like that that are the pretty clear conflicts of interest. And you go, okay, these are probably bad, and most economies that sort of go down that route end up in these corruption scandals and they smash their growth and all that type of stuff. All these negative things, but they're usually not immediate. And the question is, will 6 months of this be enough to knock the US economy off kilter? How long does he need? Do you need years and years of it? Do you need decades of it? Yeah, I think we sort of came on and discussed uh, some of these where this. I think one of the recent ones is just the Eastern European country that has completely escaped my mind for the moment. Um, uh, who sort of went through that whole process about and what did that do to their stock market and their economic growth? And the answer was, well, it took it sort of really didn't happen. Anywhere near what you'd think. And so the question is, things might be headed in a bad path and it might be terrible and it might create all these economic problems, but if it flips around and Trump loses the House and the Senate in 18 months' time, after he's thrown all this money at it, and then all of a sudden the grift comes to a stop because you've suddenly got real safeguards again, then maybe you're in a quite a good
Mm.
economic environment. And
Mm.
so there's sort of like that. Things might be looking terrible on a number of fronts, but is it making genuine damage, or is this just chipping away at something that can still be fixed? And
And
I think
look
that's
at
what
the
markets are saying. Yeah.
yeah, and the microcosm of the storm, certainly from an Australian perspective, will be CBA, right? So, if you look at, we discussed CBA briefly last time, but it's worth just reflecting on CBA. Topped out. It was actually above 190 at one stage, which was an all-time high. And the P multiple on CBA, as we've discussed previously, is very, very, very high. In fact, great minds think alike, Cookie. CBA, bargain or dump it. One of the interesting things about CBA, though, was the commentary over the last couple of weeks that suggested the structure of the markets means that as CBA is now, 12% of the whole market, more and more people need to pile in as it goes higher. And so, therefore, you have structural issues in the market, which also reinforces these things going higher as well. So, you've got all the externalities that we've been touching on. We've got some of those automatic systems and processes. We've got the indice tracking elements there too. So all of these things are reasons why this show may not actually end as quick as some people think.
Yep. I've still got a few more of them to go.
Yeah.
We'll jump back onto the there's one argument that's saying, well, if you've seen a sudden market rise and it's all just because of equity flows,
Yeah.
so all of a sudden a whole bunch of people have got into equities, then that's not a sustainable rise. And so you want it to be you don't want it to be sort of a sudden rush. And so what we saw, so that we do see this big spike in recent times where 4.5% of equities came through, but that was back in February. That was sort of pre this whole thing. That was what pushed the market up to its highs, in that February March thing before we hit Liberation Day. So, has it been this sort of this sudden equity flow? No, it's not. There's a question about leverage always, and so you can look at flows, the billions of dollars of flows into these what's equity leveraged ETFs, and so somewhat this actually was the bounce back, the original bounce back. So the big flows actually started pre-Liberation Day. Then we had Liberation Day, so presumably those people lost a lot of money very quickly. But then you had the Liberation Day, and then a lot of investors were buying into these leveraged ETFs on as markets were falling, and so that sort of helped drive it higher. But if you look at the last month or so, it's not low, but it's certainly back to the ranges we saw for most of last year. So increasing leverage explains some of this, but it's not like it's a solely this whole sort of margin lending leveraged ETF type story. So there's that one. The next one, the other place you can get leverage from is options. And so if you look at option volatilities, they're really starting to come down. And what that means is, so when you get we have Liberation Day and we see this big spike up in the cost of options. And so what that means is if I want to take a bet on markets going up, or if I want to buy protection when markets go down, when I'm buying it at say 40% in what's called implied volatility, I'm paying like, I don't know, more than double the usual, probably 1.5 to 2 times, sorry, 2 to 2.5 times the usual rate that would cost me to either take an upside bet on markets going up, or hedge myself against a downside bet. So you hit these peaks, sort of peak volatility in terms of those times. What it means is that at lower levels where we are today, back to sort of very much normal levels, and arguably even a little bit low in terms of the volatility, is people can take quite big bets on options markets. And what that often means then is that flows through to the market makers and to other people in the market, is it's not these things aren't don't exist in a vacuum. So what do I mean by that is that so if I go out and buy some options, um, from a market maker, what the market maker will do is they will go and hedge those options by buying stock. So I'm going to go out and say, yeah, I think I'm going to buy, say, a call option where I might put down $1 and I might want to win. If the market goes up 10%, I might structure it so that I put down $1. If the market goes up 10%, I'm going to win $10. But if the market goes down or it doesn't rise more than say 2%, I might lose that whole dollar that I put down. So some sort of, um, you know, it's like a call option. I can only lose $1 I put in, but I've got this massive upside. Is that the market maker sitting on the end of that will be out there buying stocks, and as the markets rise, he'll be out there buying more stocks to sort of to hedge that position. And so what some of this low, if the volatility stays low and people are making these options bets, then it's sort of almost it helps to push it higher. And that's where we got to with the GameStop. Some of that GameStop and excitement was all around people and sort of gamma levels and basically arcane stuff around the back end that means that when enough options get bought, all of a sudden these market makers actually have to get out there and buy stock to sort of push markets up themselves. So anyway, so that's out there as well. So you say, well, can people take on more leverage from that? Yeah, they can. So yes, I've been through a whole bunch of these, and now keep in mind all of these are technical. None of them are sort of fundamental about you eventually need that earnings to come through, but they're all saying that look, if nothing goes wrong in the next little while, there's lots of people that either will buy in just because they're back to the phase, or have the capacity to certainly buy more than what they've got at the moment. And I think that's where you get that scenario where you could see the market go to even higher highs if nothing goes wrong in the interim. And so for us, it still keeps coming back to that point. A lot of things can go wrong. Will they go wrong? We don't know. If they don't, you're probably going to see markets higher into a bigger bubble. But if they do, then it can be it can be self-reinforcing on the way down as well. But you could certainly and the article I've pulled all these charts from very much was a look, everything's great. So the sun's shining, market's going to go higher type article. It's like, the boom's going to get bigger before it pulls apart. So yeah, lots of risks, but you're not at this position where you're just saying it's not the position where you're saying, look, fundamentals are terrible. Everyone's all got way too much equities. Everyone's all on the wrong side of the boat. They're all going to rush back the other way. At the moment, you sort of argue almost the opposite. That look, no one's particularly exposed to equities. If things keep, just not getting worse, then these people are going to come back and probably drive markets a little bit higher.
So here's a question for you. If you are actually then with a reasonably strong conviction that there is upside potential, right? Presumably you would still then go through but I need to find which stocks within the pantheon of stocks are actually the ones that are still, from a relativity speaking, maybe less expensive. Or do you just go hollis buzz and say, oh, I'll just buy the index because the index is going to go up and therefore makes my life easy? Because some people saying in the chat, well, it's all too complicated and difficult, right? Just go for the index or something, right?
Just pick the index. Look, and we've got products that do both. We've got products that if you just want the index, you buy the index. You can then decide to put extra stuff in and take it out. So it's pretty common. We find people, they might put 80% or 90% into the index, and they might have 5, 10, 20% in other stuff where they're like, yeah, I'll do that in the index, but actually, you know what? I really want some extra exposure to robotics or to AI or nuclear power or uranium or whatever it is that extra exposure to gold. Pick whatever it is you want that you can then go throw in. So yeah, so you can do all that. Walktheworld.com.au, just register under there, and we'll send you out the details about how you can do that. But so that's the index side. What we're doing in terms of the stocks we're buying, we're focusing very much on quality. Now, so the first thing is like, well, why don't you always do that? And the answer is, well, sometimes quality is expensive. And the idea that there's sort of 3 big parts of the market is the way, lots of other subcategories, but the three big parts are you're buying growth stocks, which are not making very good, which are expensive and growing really quickly, um, or expected to grow very quickly. You're buying value stocks, which tend to be sort of low margin, cheap stocks. And the question is, well, is it cheap for a reason, or is it genuinely something that's going to make it go higher? Or you can buy quality stocks, which are often can be a little bit more expensive, but often they're earning good returns, reasonable growth, low debt, high margins, all that type of stuff like that. And so, depending upon where you are in the cycle, depends on what you think it is. If you think this is going to be a mad boom, you want to be buying growth stocks. They're the ones that are going to, they're the ones that are going to fly the most on the way up. But if it goes into a crash, they're the ones that are going to fall the most as well. Quality stocks tend to, on the way up, sort of hang with the market, and then when the markets take a tumble, they don't fall as much as the rest of the market. And value stocks are actually generally sort of a little bit negative on your portfolio, and then every now and again they come really good and give you these great returns when everything else is giving you bad returns. And so for us, what we're trying to do is interplay this value versus quality sort of measure. And at the moment, look, quality stocks, look, they're never cheap. It's very hard to find them cheap, really cheap. But on a relative sense, they're not particularly expensive. And so for us, it's about trying to load as many of these into our portfolio. And these are the stocks that often you just want to stick in the bottom drawer. I buy them, I forget about it and come back in 20 years' time and they're higher type stocks. And you just sort of, it's all about saying once you've got those stocks in your portfolio, I'm monitoring for them when they're no longer a quality stock. But as long as they're quality, they keep bringing through that growth. You just leave them there and let them grow. Whereas if you're going to buy a value or a growth stock, you want to be a lot more circumspect about, okay, I bought this stock because it was cheap. Now it's less cheap. I want to be selling it and moving on to the next one. Or I'm buying a growth stock. Well, I want to be sure that markets are in this growth phase because when they turn, these are the stocks that are going to rise 40% when the market's up 10, but when the market's down 10, they're going to fall 40%. And so, they're the sort of the quid pro quo of making sure that you're in those stocks at the right time.
And Jump for Joy asked about, examples of growth stocks, or even if not specific stocks, maybe sort of illustrative sectors would be helpful.
Yeah, well, so Tesla is probably a good one as a growth stock. The question is about whether they are actually still growing. It's priced like a growth stock. Let's put it this way: it's priced like a growth stock. I think there's a lot of stocks which sort of they fit. Nothing ever falls exactly into these categories, but a lot of the ones which we're invested in terms of quality ones are a lot of those bigger stocks. So your Microsofts and Nvidias and stuff like that, where the growth's been really strong, but the quality is also very, very high in terms of the earnings. There's stocks we sort of try to measure from a let's say it's talking value stocks, like something that the car sector sort of very much ranks as a value sector in that you can buy these things. So we talked about market PEs being 22, 24. Most car companies you can buy on a single digit PE. So, they might have a PE of 8 or 6 or something like that. But the flip side is, you're a big car company. You've got lots of other car companies competing with you. Everyone's competing on price, and you've got all these EVs and cheap cars coming out of China that are all trying to compete with you. And so maybe the car company of yesterday is not going to make as much money in the coming years. And so great example of a quality stock where it's cheap, but it's cheap for a reason. And then it's a question of saying when is the right time to be buying into those growth. Yeah, so that was an example of each of them, I think.
And
sorry, the other one actually on the growth side, the other one I'd say is most loss making companies will tend to be growth stocks. In that you're basically buying this company that's a loss making company because I'm expecting that it won't be a loss making company in the future. So a lot of the sort of more cutting edge or bleeding edge of the IT boom and the AI stocks, they're very much in that sort of growth category. Yeah.
And Cookie Boy here asked about the mining stocks. Do you think they're a good value considering China's economy? I turn the question around. Where would you put the mining stocks in those three categories at the moment? And maybe iron ore is different from lithium. I don't know.
Yeah. Okay. So well, look, they are from that perspective. I think there's typically you'd either put mining's never a quality stock. They're never quality stocks. They're either growth stocks at certain times of the cycle or value stocks at other times of the cycle. So and different markets will sort of give you that. So you'd argue that iron ore's more of a value stock type play at the moment, and lithium is more of a growth stock. For me, a lot of these is about cost curves, where you sit. So a lot of the longer term cost of these, so lithium's this fascinating one. Actually, let me talk about the other minerals first. Let me talk about some of the other minerals, especially in terms of China. So iron ore, we're quite negative on. We've been negative for a while on that one. It's this idea that, look, China used to build a lot of buildings every time they ran into economic problems. Now they're trying to build semiconductor factories and a lot more automation, and they're not going to sort of run that whole playbook back. So from that perspective, look, yeah, I agree that with China headed down in terms of the housing market within China, that iron ore is not somewhere you want to be, especially again with Simandou coming on as well and throwing more sort of high quality ore at this problem. So then you sort of go, so that's one end of the very much just the buildings stage of it. At the other end, you look at something like lithium, where it's to me, lithium's a sector where the growth is there in terms of the volumes that's coming out. So that sector, but because things are growing so quickly, it's this part about if volumes grow at 30% next year, but demand grows at 40%, prices are going to boom, or even 35%. Prices are going to boom because there's not enough demand. Demand's growing at 40, this thing's growing at 30. If supply grows at 30% and demand grows at 25%, which is still fantastic growth, but it's less than what supply is growing at, then prices crash. And that's the problem with lithium is it's this idea about you're really mucking around these quite narrow sort of ranges where the lithium producers know how fast that demand is growing, and so they're not going to shut down. So how can I put it another way is if the iron ore price falls down to $70, there's a whole and it looks like it's going to stay there. There's a whole bunch of iron ore mines that'll just shut down. They'll just go, okay, I can't produce at that. There's not much growth out there. Simandou's coming on board with all this extra supply. You know, if it's at $70, I'm just shutting my mine down, and that takes demand out. Takes supply out, and that sort of helps sort of rebalance that price. In lithium, when people look and go, okay, my project is no longer making money, but I can see all this growth coming through, and so if I just do nothing and people stop building new lithium mines, then demand will catch up because it's still growing at 25% per annum or 20% per annum. And then the price will come back and then I won't have to worry about this. And so that's the part where lithium's about the price signals effectively telling people building new mines, okay, stop building new mines. And so they stop. But then you have to wait for that sort of uh, now demand keeps going while supply comes to a stop, and then all of a sudden prices start rising, and everyone goes, "Oh, I've got to put these new mines back on again." But it takes a while to get the mines up and running, and so then the prices go flying sky high, and that's the cycle we've been through since whatever 2010. We've sort of been through that sort of two massive big peaks, and then back down into these troughs again. And I think you're going to keep going through that from lithium. And so the thing to keep an eye on for lithium is, look, the price. $5,000 to $10,000 is where a lot of these guys have their cost. A lot of the higher cost ones are at the sort of 5 to 10,000. The good ones are sort of sub 5,000. And so what that means is when you see prices of $100,000 for lithium is like, okay, they're making great profits, but there's going to be a flood of new supply coming on, or not even 100,000, 50,000, whatever. There's a flood of new supply coming on. And so you sort of want to be going at those higher prices is when I want to be getting out. And then when you're back around, 5 to 10,000, as long as you believe in the battery story and that whole pickup, then that's a good time to be buying lithium stocks because they're cheap. And those prices aren't high enough for people to go and build new mines. They're going to need prices of sort of $20,000 or more for people to want to get out and build new mines.
Absolutely. And I think that underscores that, you can't stick all the miners in one basket. There's got to look at some more of the
No.
fundamentals and the market evolution and
Yeah.
all of those things.
Oh, yeah.
Go on.
Okay, that reminds when you say fundamentals of miners,
Yeah.
like when I was speaking around those ones. So when the lithium price is $100,000, these things are trading on 10 times PE or 5 times PE.
Yeah.
They're like this thing's making, it's making $5 a share and the shares are only $25. It's like every year it's like, in 5 years it's made its share price in terms of that. But the reason why is because everyone's looking at $100,000 going, that ain't going to last. That price is going to fall. And so now they're making, now they're back to making $2 oh sorry, now the thing's making, the share price, sorry, the lithium price crashes and now they're making, 50 cents a share and the share price is whatever, $10. And so it's like on 20 times PE. So you've
Mm.
gone on 5 times PE. I actually wanted to sell this thing. And now it's on 20 times PE or 25 times PE. Now's the time I want to buy it because now actually what's happening is the prices are really low and that the profits is what's going to rise. And that's what's going to drive it. So when you're talking fundamentals about uh, you know, a car company, an industrial company, all these other ones who aren't reliant on that price part, who are just out there producing stuff. I want to see that profits going up. And when profits are going up, that's a signal that yeah, things are going well. They're expanding stores, they're doing more. I want to own that company because it's a good quality company. In mining, it's exactly the opposite. When prices are really high, it's like, no, this ain't sustainable. I know that $100,000 lithium is not sustainable. People will just go to other materials and it won't be worth doing stuff at 100,000. Whereas at 5,000, I know that's not sustainable as well because the lithium company is going to go broke, and there's this huge demand for more lithium. So yeah, it's a it's up is down. It's a different. Yeah, you need to think about mining stocks differently to how you think about other stocks.
Absolutely. And talking about other stocks, one that I look at quite often is because I'm interested in the financial services sector is Macquarie. And Macquarie is quite interesting insofar that if you track it back, is the chart over the last few years, you can see that we're knocking around 226 again. Quite significant growth, bit of wobble sideways. But if you look at the performance of that relative to, for example, NAB, which is one that I can sort of compare, you can see there's quite a difference of footprint between the NABs and the Macquaries. And I think, again, it highlights quite nicely the differential analysis that it's worth doing between stocks that superficially at least might appear to be in the same sector.
Yeah, that's right. Macquarie is quite different to what you're looking at within NAB. Yeah,
Mm,
so I sort of feel like the most of the major banks in Australia, there's not a lot of difference between them, but Macquarie is very different.
yeah,
So if you want to compare Westpac, ANZ, CBA, all those ones, just in terms of what are they actually doing out there, there's really not a lot of difference. There's a bit of scale, a bit of the things, but they're all effectively just making lots and lots of housing loans. And so, yeah, whereas Macquarie, that's not the case. No, they're a lot more involved in a whole bunch of other different capital markets, and that's one of those ones where we've certainly seen from a lot of the US investment banks as well. Is this volatility is usually good for them?
mm,
Is that they're a whole bunch of people wanting to sell out, a whole bunch of people wanting to buy back in, a whole bunch of people wanting to sell out again and buy back in again, and they might have done a round trip and net the market's gone nowhere, but trading revenue was fantastic. So.
absolutely. And just on the credit growth, the latest numbers came out a couple of days ago, and it showed that housing credit is still growing at a 0.5% monthly pace, which is significantly above the inflation rate. And if you go back over the last few years, the growth of credit for mortgages in Australia is definitely underpinning the major domestic banks. Whether that's a good thing or not is a different story, but that's part of the story as to why house prices are continuing to bubble higher. High migration, yes, but significantly higher lending than the sort of the CPI level.
Yeah, yeah, absolutely. And that's why if we've got more policies, I must admit, where did we get to in the lending 5%? Have they got some legislation ready to go yet on that? But there's anything
Yeah.
that's sort of encouraging that more debt more, higher levels of debt just to inflate, prices of existing assets is typically poor policy and bad for productivity.
Absolutely, but it's definitely the story of the day. Now, one other thing I just wanted to touch on, because talking about commodities, we should just touch on oil, and of course, the oil price reacted very strongly when we had the bombing over a couple of weeks ago, and then it's dropped back significantly. But I thought this was a really interesting slide, which shows the relative production by country. And I just want to highlight how much oil is now being produced by the US, right? They're way up
Mm,
there, right?
that's
Ahead of
right.
Russia and Saudi Arabia and what Canada, Iran, Iraq, all the other mob. This changes the game, doesn't it?
Yeah, absolutely. Um, and what's interesting that's on that one. So it's interesting they're measuring it in terawatt hours, isn't it? And so
Mm,
I mean, because so back in the 80s that mattered. That was
yeah.
if you looked at Saudi Arabia, they powered half their economy from burning oil.
Mm.
Whereas it's been a while since anyone's ever wanted to burn oil to
Generate
produce
electricity.
electricity.
Yeah, exactly.
Yeah,
But
but
it's the relativities just amaze me.
yeah, and the other thing to remember with what's really interesting with oil in the US is that's what's driven the low energy prices for gas in the US as well,
Yes.
because with the technology they use, the fracking, in order to get the oil out, uh, the gas has been pretty much a byproduct. And the US hasn't been able to export the gas until recently. And so what it's meant is I'm chasing 80 or $100 oil. And so I'm like going, yeah, let me get in. And here's something that's quite expensive to do. And you know what? I get all this extra natural gas come out with it. And so I just pour that into the local market and it depresses gas prices, which means energy prices stay really low in the US. And so there's been this real, I think it's sort of um, an undertold story about how much of the great performance of the US versus the rest of the world has been low energy prices in the US for whatever the last couple of decades. Where if you got the what's the Henry Hub gas price as well?
Yeah, hang
That's
on. I think I can get that.
uh,
Uh,
um, yeah, but that's so. They've now and they're now trying to do. There's a whole bunch of export terminals coming on. There's a few Canadian export terminals coming on, which is probably going to equalize that a bit more. Um, but that oil price is that oil production in the US, yeah, just showing how much they're producing is um, is
yeah,
a yeah is
just
they
see.
don't need to go to war in the Middle East anymore. Maybe that's
No,
the
no, no.
best way to put
So, so
that.
I think that's the one you want, the Henry Hub.
Yeah,
Yep,
yep. So the oh no, that's a German one. Sorry, that's a Germany. Oh, what's actually what is that one? Nerd gas, Germany.
it's on the extra, but it's the Henry Hub ERD
Right.
gas.
Okay. Yeah, but you can see it three
Yeah.
dollars, and it's sort of
So the point is,
I think
this is the gas price in the US, right? Rather the relativity.
yeah.
So it's come down, and the reason that's important is that relative to what's happened, for example, in Australia, where gas
Mm,
prices have gone absolutely through the roof, and of course in Europe as well, it's gone completely in a different direction. And this is because of the fact that the US is now producing a lot more gas, as you said, through the byproducts of fracking.
yes. Um, Let me just pull up. I just want to check what I feel like it's so yeah, the equivalent for Australia. So the US is yeah 350-ish,
Mm,
and the equivalent for Australia is more like 10 or 12,
10 to 12,
and then
yes.
Europe sort of sorry yeah, I'm not quite sure where they are in Europe, but the Japan ones tend to be another more like $15.
Mm,
But yeah, that Henry Hub has been. Yeah, see, that's right. The peak back in 2022 was almost 10 was $9 where it got to. So it's sort of been trading at $3 for a couple of decades now. Just a third the cost of what energy was in Europe, even with Russian gas.
yes.
And without Russian gas, it's whatever, 1/6 or something like that. And so that just means there's all these things that are all these chemicals that are just cheaper to produce in the US if you've got that cheap energy. All this electricity is cheaper. There's just this whole underpinning that's sort of undertold. So yeah, it's and then there's obviously the flip to electric vehicles that's sort of going on at a reasonable pace in terms of that. So that's sort of reducing or certainly putting a limit on demand for oil as well. So
Absolutely. And I'll just highlight, of course, the government sort of announced in Australia a sort of quasi investigation inquiry. I'm not sure what they're going to really do yet to do with the gas price, right? Because they finally, I think, have been not able to resist the huge, obvious, blinding issue. Australians are paying too much for energy because they're paying too much for gas.
That's right. So we've got on the East Coast.
On the East
On the
Coast.
East Coast, we have an East Coast gas cartel who is excellent. Has done an excellent job at convincing both sides of politics that they need to keep gas prices high. And so, if we, I don't know what'll happen there. That's so I think we saw. I didn't look at the detail, but it looked like they're starting to float some trial balloons out there. They spoke about gas reservation and a few other things like that. So hopefully that sounds good. But the gas reservation sounded like a pretty weak type of gas reservation.
Correct.
It sounded like, maybe a few small projects that are coming on in the future.
Call me an old skeptic. I feel as though they're sort of just nodding to the obvious without necessarily doing much at the end of it. So it's sort of, seem to be doing something rather than doing something. But it's a fundamentally important point, right? Because again, I want to highlight costs of energy in Australia is strangling the Australian economy, right? Manufacturing is just closing down because it's too expensive to actually make paper or glass or anything in Australia, aluminium, whatever, right? Yep. It's too expensive.
Building products, all the building products are going up. Yep.
And what that does, what that does then is to put trade exposure then onto the Australian economy, firstly. Secondly, you have no issue over controlling supply chain because you're reliant on stuff coming. And what that also means is, of course, that you're actually losing the base of the manufacturing, the base of the economy. So, we've said before, Australian economy, the housing market with a small pimple on the side called the rest of the economy.
Yeah, and we don't tax the gas guys, and so it's basically we're ripping this gas out of the ground that is legally Australians. It's not legally the government owns the gas and it lets the companies build their things and extract it, but we're basically letting them take it all out and just not charging them anything for it and not getting any benefit. So we're punishing our own internal all these other companies within it. They talk about it being, this idea of, there's sovereign risk and all these things like that. I mean, look, Trump's a great example of, he's decided America first, and this is what is the most important thing is America first. And, yes, we'll tear up whatever agreements, whatever it shows, it's but Australia sort of, on the part of the gas companies have convinced us that, and that we can't change things. But also, really what the gas companies did was they came along and they basically said, you don't need gas reservation. We're going to build all these gas-fired plants. We've got so much gas in the east coast of Australia. Why would we ever need gas reservation? There's so much of it. We're going to build all these export terminals. There's all this extra gas out there. And we're gonna go and do all this extra exploration, and we've already done the exploration. We're gonna go and build all these wells to get all this extra gas on there. And then once they'd had everything approved, they basically went, well, actually, you know what? Why do we need to buy all these? Why do we need to go out and create all this extra gas and that we found? Why do we need to tap the wells and do them when maybe we can just go and buy all the cheap guys and drive the price up locally, and then we don't have to worry about it. And that's effectively what they did. And we've ended up in this situation. We've gone from what should be one of the cheapest, most energy-rich countries on the planet. We've got, some of the best renewable resources. We've got, great solar. We've got cheap gas, plenty of coal, stacks of uranium. Like we should have low energy prices, but we've managed to, create an economy where we've allowed the companies to extract all the benefit from it without giving it back to people.
Yeah, and then to add insult to injury, this is the latest export volumes statistics, which shows you that it's resources all the way. Services going sideways, rural goods slightly up, and other goods maybe slightly down. And by the way, services would include education. Cough, cough.
That's what I was just about to say. I was just about to ask if that was the case. Yeah, which is pretty much a fake. And sorry, just to explain why I'm saying that's fake is is that you effectively say when somebody comes over here, a poorer student, say, comes over here, they get a university degree worth $50,000 or whatever it is. They then go out and work, and they earn whatever money they earn and spend. They're treating that money that they go out and get a part-time job to make $30,000 a year in order to pay for all the expenses. They're treating that $30,000 as being an export.
Yeah.
And you're like, on what world is somebody coming here and working and then paying for their all their stuff, and what world is that an export?
And the purpose of my showing this chart was also to highlight the risks to the Australian economy, right? Because as China, potentially dials back perhaps future demand for some of our resources exports, that's going to put a huge impost on the Australian economy. And there's already some concerns about the budget deficits, et cetera, et cetera. And I know that there was more tax taken because people are being taxed higher, et cetera, et cetera. But this is a real problem because the narrow base of the economy continues to shrink. And you've got to say, well, maybe if I'm investing, I don't necessarily want to put all my eggs in the Australian basket.
No, that's right. Yeah. And so, resources of the Australian market is whatever 30 something percent of the Aussie market. You look at the globe, how much is resources as a percentage of the total global market, and it's less than 2%. It's a drop in the bucket.
Yeah.
So, I've probably put this chart up for you a couple of times. I haven't got it handy with me, but it's the one that says, if you're looking at industries, there's some industries that are there to produce new innovative things and provide new services and stuff like that. And there's other industries out there that are just toll collectors. They're like, I've built a highway, now I'm going to charge you to drive on that highway. I've built a pipeline, I'm going to charge you to do that. I've built a building, I'm not going to do anything else. I'm just going to charge you rent in order to, you find the innovative company, you need to lease space, you need to come and lease space from me. I'm just a toll collector on this. And then you have the banks and finance, which is actually saying out there, okay, you guys are meant to be collecting money from everyone and putting it into these, the innovative companies. And so you're effectively just a toll collector as well. Like you're just there to, a bank is there to, divert money from one set of people to the growth people and clip a ticket on between. So you sort of go, okay, if I looked at the globe and looked at all the investment markets and said, how much are these either resource companies or the toll collectors, your utilities, REITs, your banks, all these guys that are just providing services to the rest of the one, how much do they make up of the total market? And most global markets, it's 15% or less. And in Australia, it's like 75%. And so you're basically saying, when I invest in the Australian stock market, I want to invest in ticket clippers. I want to invest in people who are there to take money from the others.
Yep.
And the fact that banks are so profitable in Australia, and you're like, well, why is these guys whose job is meant to provide finance to the people who want to grow, why are they taking all the money? Shouldn't we want them to be making a much lower amount of money and allowing, growth companies and innovative companies and companies that are doing new things to get out there and get cheaper financing and grow the economy. Whereas there's some pretty good arguments out there about saying that economies are shaped by yesterday's sort of heroes. And it's the part about, when you have innovation and new industries start up, it's the old industries that are always want to be, they're the ones with the money who are getting the politicians to write the laws in favor of them and keep everything sort of status quo. They want to sort of try and shut the door so that new companies can't come in. And the more you let that happen, the worse it is for these companies trying to do different things. And so we've got these companies that have grown rich by owning property basically, or digging stuff out of the ground and selling it, who are all busy trying to make sure the laws help them along and away from the innovative companies. And I think it's true even within the US, is that the rise of and they're a long way further behind, I guess, in this process, but the Googles and Apples and Nvidias of the world never used to be lobbyists. Like, they never used to turn up next to the all the presidents and have all this stuff. They were the new ones trying to break into the market, and it was the big media companies and the telcos who were like saying, you got to regulate these guys. You got to say, you can't let these guys come and steal our lunch. You got to get in there, and they were the ones paying the money to do it. Nowadays, it is these bigger companies now saying, and I think it's still early stages for them, but they're the ones trying to get the laws written to stop the new entrants into it. And there's that ongoing part where you're trying to, it's a push-pull, I guess, of trying to work out, it's often a sign for me when I see companies, lobbyists and spending lots of money to try and get these laws rewritten, is actually saying, is that starting to sound like it's the beginning of the end for them?
Mm-hmm.
They've reached the peak, and now it's just trying to shut the door behind them and keep the competitors out rather than trying to innovate and grow and do new things.
Which, of course, is precisely what the banks in Australia have been doing for quite a few years with their heavy lobbying of the parliamentary system and everything else. And
both the banks and the gas companies have done fantastic jobs, the lobbyists there.
I was going to
they
say,
deserve more money.
Yes, exactly right. And I'll just remind everybody that when you talk about clipping the ticket, who is it who's paying the ticket? The answer is it's mostly households. So one of the reasons why households' cost of living are so high in Australia is because whether you're going to actually use the toll system when you're driving, or petrol when you fill up at the Bowser, or buying electricity, gas, etc. Wherever you look, mortgage payments, it's the clipping of the tickets that's actually put the cost of living up more than anything else. And that's why we've got this huge pressure on many households at the moment, and why real incomes, I don't think the 3% inflation respects the real situation, reflects it. The fact is, a lot of people are really struggling, and it's because of the structure of the economy.
Absolutely. So yeah, one more reason to get some more money offshore. And look, the US dollar has been weak, so there is that sort of hasn't been great for international investments. But the question is, I think the Aussie dollar certainly has got some tailwinds at the moment relative to the US dollar. But I do think there's a longer term argument which is saying, well, if I'm investing for the next 3 weeks or the next 3 months, then maybe there's an argument to say, well, will the Aussie dollar head higher, and will it be, But I think there's a better argument over the longer term to say, with the fall of the building sector in China in particular, and the growth and the pressures that Australia is facing, particularly the productivity that Australia is looking at in terms of, we've just had such weak productivity growth for years now, is that sort of all points to a lower Aussie dollar over the medium term. So short term, I think there's other issues at play, but over the medium to longer term, if you're talking about putting a portfolio together over for the next 10 years, I'm certainly looking at pushing more into that international and taking that bet that the Aussie dollar is going to be lower over that time frame.
Interesting. And I'll just compare that with the pound. It's going a completely different direction at the moment. So, it's 51, 52. Now it's 47. So it shows you that differentially, it's all about the positioning of the Aussie dollar versus the US dollar, and the weakness of the US dollar, which is really having a significant impact, which suggests that if that were to change, the Aussie might be going somewhere rather different.
Yeah, well, and it's this part as well that if we're looking at rate cuts, significant rate cuts in Australia, then you'd expect the Aussie dollar to sort of to suffer from that. So for example, Canada, which has obviously got a lot more issues in Australia, but it's given its exposures to the US and tariffs and all that type of stuff like that, but it's a pretty similar economy in terms of resource dependent and educated and smaller populations and concentrated and all those types, and higher house prices, and there's a lot more similarities than differences. and their interest rates, and particularly their long-term interest rates are far lower, sort of around sort of the 3% for some of their longer-term ones. So you can knock another if Australia sort of heads in that direction, and those longer-term interest rates come down, then that's certainly a negative for the Aussie dollar.
Yeah, absolutely. And it is fascinating just watching how these things are playing out. Well, we're coming to the end of the show, Damien. So I think in summary, what we're saying is there's a level of uncertainty that still exists at the moment. It's not necessarily, though, everything's going to crash. There is also a coherent set of arguments that suggest that markets could still go higher over the next little while, which of course then means you've got to think carefully about how you manage your portfolios and where you invest and which countries you invest in and all those things that we've been talking about and the different mix of stocks. And again, just to highlight the world funds which you look after, give people access to a number of different permutations and options and tools to be able to do some of that. So if you're interested, the links are below to pursue that. Interestingly, I did ask people what they thought about the next 12 months. I said, do you think the ASX, which went up 10% this year, is going to do the same or better next year? We've got the answer that says 25% says yes, 46% says no, and 29% says cannot say. So that gives you a bit of a sense of where the viewers are sitting at the moment. So a level of uncertainty, I think, is probably the thing. And to my mind, that's the critical thing, right? What if you're wrong is always the other question you've got to ask. What if you are wrong? So don't necessarily put all your eggs in just one strategic basket at the moment, because there is a level of uncertainty that's out there.
Yeah, exactly. And there are so many things that can go wrong at the moment. I don't underplay how many things are that can go wrong.
Yeah.
But there's also a path to, avoiding of anything to avoid all the landmines and ending up being in this economy where it's just ripping with productivity growth from AI, government spending money that corporates are lapping up, greater inequality with all these people with more money to invest. So investment markets are just higher because there's more money there's more savings out there. There's obesity rates have stopped rising in the US. Driverless cars are, Google's now doing 250,000 rides a week or whatever in their or month in their cars, and scaling out to more and more cities. There's just all these productivity things that are coming through, and the amount of automation in terms of robots have obviously reached this level where the automation, is hit this real turning point about people no longer needed in these things. So there's these great productivity gains that we're seeing in the US and other countries. Not seeing as much in Australia, but we'll leave that to the side. But you could sort of see this path where, as long as it doesn't fall off and the dominoes all tumble and you run into that problems, that you can be in this place where things look a fair bit better without underplaying the risks. So I guess what I'm saying is cautiously invested. You want to have a certain amount. You want to be sitting close, looking at a whole bunch of things that could go wrong as to whether you need to flip. But sitting on the sideline and waiting for the time when someone's going to tap you on the shoulder and say, Martin, now's the time to invest everything. It ain't going to come.
No. It strikes me we should be resurrecting the narrow path, right? There is a narrow path through this that could actually lead to prosperity, but looks a bit wobbly either side.
It does look very wobbly either side, but we've trod the narrow path so far, and the whole taco trade. Trump generally doesn't want things to go badly for the economy. Like he does want a rip roaring economy, and he doesn't care about debt, doesn't care about low interest rates and inflation and all that stuff. So,
Damien, thank you so much. Really appreciate it as always. We'll get you back on in a month's time and beginning of August, and we'll be able to sort of check the pulse on the markets then. Who knows where we'll be? I'm sure there'll be some more things to talk about. But thank you very much for sharing your research and your thoughts as always. And
thanks.
Really appreciate it. And we'll see you next time, Damien. I'm going to take you offline now and finish the show.
Thanks. See you.
So there you go. And just acknowledgement from Jason. Jason, thank you very much for the super chat. Really appreciate it. Always help to cover some of the costs. So thank you for that. And I want to say thank you very much for everybody else who's been following along and putting comments and things in the chat, been following that as well. Please like and subscribe if you haven't yet done so. It does help us to keep the show on the road. We've actually got 2 doggies in the baskets now. So, 1.5 dogs in the baskets. So there we go. That's the story there. Meteor is in her basket. Luna is sort of rather stretched out. She's over there. There you go. So she's definitely cooling off, being rather warm here. So that's it. There will be a show next week, and I think I'll be talking about the latest analysis from my modeling, unless I get a special guest on, which is just a possibility. So hold your breath and see what happens next week. And check out the recorded shows every day of the week meantime. Thank you very much for spending some time with us. Have a good evening. Keep dry if you're in New South Wales, and I look forward to seeing you in the next show. This is Martin North from Digital Finance Analytics signing off. Take care.